Picture this. It's tax season. You're sitting at your desk, surrounded by forms, stressed out, watching a significant chunk of your hard-earned paycheck vanish into government coffers. You pay your fair share because that's what you're supposed to do. It's the price of living in a civilized society. Now picture a different scene. A billionaire CEO whose company is worth more than the GDP of some small nations. They live in mansions, fly private jets, and their wealth grows by millions while they sleep. But when tax season comes around for them, something unbelievable happens. Their effective tax rate, the percentage of their real income they actually pay, isn't 20%. It isn't 10%. Sometimes it's shockingly close to zero. How is this possible? Are they criminals? Are they stuffing cash into duffel bags and burying it on desert islands? No, and that's the most terrifying part. What they are doing is, in most cases, completely 100% legal. They aren't breaking the system. They're using a different version of the system, a version built specifically for them, designed by lobbyists and hidden behind a wall of complexity that average people can't penetrate. It feels like a rigged game, and today we are going to crack open the rule book. Welcome. In this video, we are going deep inside the world of elite wealth management. We are going to deconstruct the precise strategies from the buy, borrow, die loop to sophisticated offshore structuring that allow the ultra-wealthy to legally opt out of the tax system that the rest of us are forced to live in. Buckle up. It's time to see how the other half doesn't pay. The crucial distinction: avoidance versus evasion. Before we dive into the strategies, we need to establish one absolutely critical concept. If you try what we are about to discuss without expensive lawyers, you will go to prison. The difference between a smart billionaire and a convicted felon often comes down to two words: avoidance versus evasion. Tax evasion is illegal. It's lying about your income, hiding cash under the mattress, or fabricating deductions. If you get caught doing this, you face massive fines and jail time. Tax avoidance, however, is legal. It is the art of arranging your financial affairs to minimize tax liability within the boundaries of the law. The courts have repeatedly ruled that no one has a patriotic duty to pay the maximum amount of tax possible. The problem is, the boundaries of the law for the average person are a small fenced-in yard. For the ultra-wealthy, those boundaries are a massive, open landscape filled with loopholes the size of semi-trucks. The strategies we're discussing today are highly sophisticated forms of tax avoidance. They are the privilege of those who can afford armies of accountants whose sole job is to find the cracks in the code. Let's look at the biggest crack of them all. The golden rule: income versus wealth. The foundation of nearly all elite tax strategies rests on a simple flaw in how most tax systems are designed. They tax income, not wealth. You and I pay taxes on our income. Your salary is taxed before it even hits your bank account. The ultra-wealthy, they often have very little income in the traditional sense. Jeff Bezos, Elon Musk, Warren Buffett, their massive fortunes aren't sitting in a savings account collecting interest. Their wealth is tied up in assets, primarily stocks in their own companies. Here is the magic trick. In most jurisdictions, you only pay taxes on stocks when you sell them. This is called capital gains tax. If your stock portfolio goes up by $1 billion this year, but you don't sell a single share, how much income tax do you owe on that billion-dollar gain? Zero. It's unrealized wealth. It exists on paper, but the taxman can't touch it yet. So the first rule of the rich is simple: never sell. But wait. If they never sell their stock and they take a $1 salary just for show, how do they pay for the mega yachts, the mansions, and the private jets? How do they buy groceries? This brings us to the most powerful tool in the billionaire's arsenal. Here is the magic trick. In most jurisdictions, you only pay taxes on stocks when you sell them. This is called capital gains tax. If your stock portfolio goes up by $1 billion this year, but you don't sell a single share, how much income tax do you owe on that $1 billion gain? Zero. It's unrealized wealth. It exists on paper, but the tax man can't touch it yet. So the first rule of the rich is simple: never sell. But wait, if they never sell their stock and they take a $1 salary just for show, how do they pay for the mega yachts, the mansions, and the private jets? How do they buy the buy, borrow, die loop? This strategy is so effective and so widely used by the 0.1% that economists have given it a catchy name: buy, borrow, die. It works like this. Step 1. Buy assets that appreciate in value. Stocks, real estate, art. As we just established, as long as these assets grow in value, you pay no tax on that growth. Step 2 is the genius part. Borrow. If you need $50 million for a new lifestyle purchase, you don't sell $50 million of stock. If you did, you'd have to pay millions in capital gains tax. Instead, you go to a major investment bank. You tell them, look, I have $10 billion in company stock. I want to borrow $50 million, and I'll use my stock as collateral. The bank loves this. It's incredible security for them. Because the loan is secured by such massive assets, they offer extremely low interest rates, often lower than inflation. Crucially, under the current tax code, borrowed money is not income. It's debt. You don't pay tax on a loan. So you now have $50 million in cash, tax-free, to spend however you want. But how do you pay back the loan? You don't. You just let the interest accumulate, or you borrow a little more next year to pay the interest on this year's loan. You keep rolling it over. As long as your assets are growing faster than the tiny interest rate on the loan, your net worth keeps going up. This brings us to step 3. Die. This sounds morbid, but it's the cornerstone of generational wealth transfer. When you eventually pass away, you might have hundreds of millions of dollars in outstanding loans, but you also have billions in assets. Your estate sells some assets to pay off the loans. And here is the final magic trick of the tax code, something called the step-up in basis. When your heirs inherit your assets, the tax value of those assets is reset to their current market value on the day you died. All those decades of gains wiped clean for tax purposes. Your heirs can sell the stock the next day and pay little to no capital gains tax. The buy, borrow, die loop is virtually unbreakable. It allows immense wealth to sustain a lavish lifestyle without ever triggering a significant taxable event. The offshore illusion. Now, let's talk about the one everyone knows from the movies: offshore banking. The Cayman Islands, Switzerland, Panama. The popular image is a shady guy in a suit carrying a briefcase full of illicit cash to a tropical island. While that happens in the criminal world, the legal version is far more boring and far more effective. When a wealthy individual or a corporation moves money offshore, they aren't usually physically moving cash. They are moving legal ownership. They set up shell companies in jurisdictions known as tax havens. These are countries with very low or zero corporate tax rates and strict secrecy laws. Let's say you have intellectual property, a patent, a logo, or a software algorithm. You transfer the ownership of that IP to a shell company you control in Bermuda. Now your main company back in the US or Europe has to pay the Bermuda company to use that IP. This creates a massive expense for your onshore company, lowering its taxable profits significantly. Meanwhile, the Bermuda company receives that money as pure profit, and Bermuda taxes it at 0%. You have effectively shifted profit from a high-tax zone to a no-tax zone, all with a few digital signatures. The OECD estimates that countries lose up to $240 billion a year in tax revenue due to these corporate profit-shifting schemes. It's a global shell game where the money is always moving faster than the regulators can track it. Philanthropy as a shield. The final strategy we need to discuss is perhaps the most sensitive: charity. Don't get me wrong, many wealthy people are genuinely generous. But philanthropy at the billionaire level is also a highly sophisticated financial tool. When you donate money to a registered charity, you get a tax deduction. This is good. It encourages giving. But the ultra-wealthy often use vehicles called donor-advised funds or private foundations. Let's say you have a terrible tax year coming up because you were forced to sell an asset. You take $100 million of highly appreciated stock and donate it to your own private foundation. Instantly, you get a massive tax write-off for the full market value of that stock, potentially wiping out your tax bill for the year. Furthermore, you don't pay capital gains tax on the stock you donated. But here's the kicker. The money is now sitting in a foundation that you control. You can't take it back for personal use, but you decide how it's invested, you decide which charities eventually get the money, and you can even hire your family members to run the foundation with hefty salaries. You have effectively removed $100 million from the tax system, received a massive immediate benefit, and retained significant control over the capital. It's charity, yes, but it's also incredibly efficient wealth management. The reality check and what you can do. So where does this leave us? It leaves us angry. It feels unfair because, frankly, it is. The system is engineered to reward those who already have capital while heavily taxing those who earn income through labor. But as we watch this video, anger won't lower your tax bill. The harsh reality is that you cannot use the buy, borrow, die strategy. Bank of America isn't going to lend you $1 million against your 2015 Honda Civic at a 1% interest rate. You can't afford the legal team to set up a double Irish-Dutch sandwich offshore structure. If you try to play their game without their resources, you will lose. However, understanding how they play the game reveals what you can do. The underlying principle of the wealthy is reduce taxable income and maximize long-term tax-advantaged growth. You can't copy their tactics, but you can copy their principles. Here is the playbook for the rest of us. Number 1. Stop ignoring tax-advantaged accounts. Are you maxing out your 401k or your IRA equivalent in your country? This is the closest the average person gets to the buy, borrow, die principle. You are shielding your money from taxes today so it can grow tax-free for decades. It's not sexy, but it is mathematically powerful. Number 2, understand the power of long-term holding. Remember, the rich don't sell. If you are constantly trading stocks, buying and selling every week, you are generating short-term capital gains, which are usually taxed at a much higher rate. The same is your regular income. Real wealth for average investors is built by buying quality assets and holding them for longer than a year to qualify for lower long-term capital gains tax rates. Number 3, utilize every legitimate deduction. The wealthy don't leave money on the table. Neither should you. Are you a freelancer? Are you expensing your home office correctly? Do you have a health savings account? Most people leave thousands of dollars unclaimed simply because they don't understand the basic deductions available to them. It might be worth paying a few $100s to a real CPA once a year rather than using free software just to ensure you aren't missing the obvious stuff. Conclusion. The stories of billionaires paying 0% tax are shocking, but they shouldn't just make us mad. They should be a wake-up call. They are a reminder that financial literacy isn't just about saving pennies. It's about understanding the architecture of the system we live in. The rich understand the rules better than anyone else. If you want to improve your own financial future, you don't need to hide money on an island, but you do need to stop navigating the tax code with a blindfold on. Learn the rules that apply to you. Maximize the tools you have access to, and start thinking about wealth over the long term, not just paycheck to paycheck. Thanks for watching. If you found this deep dive eye-opening, make sure to hit that subscribe button so you don't miss our next investigation into the financial systems that govern our world.